This is based on what PRI says, but I think in general we can categorize it in two major buckets. We can do this because it's the right thing to do, or because it makes a lot of economic sense. The good news is that both of those are actually aligned, so it doesn't have to be an either or. But yeah, PRI are sort of listing some of the main four reasons why investors should care and start doing this more. And the first one is really regulatory and the developments here, because yeah, the regulatory trends is going towards asking businesses to deliver more social value. So this is coming whether or not people want it, but either way it's coming. And again, we can think about the UK and the Gender Pay Gap Reporting Act. You have the state of California, you also have state of Illinois. There are many other places around the world where more and more reporting and the work around DI is becoming mandatory. In Europe, we have SFDR, where again some of the indicators are also related to DI and only very high level and only on gender, but more is coming even in those areas. And again, Canada, as late as I believe it was last week, came out with consultation papers around disclosure measures around this. So long story short, this is going to happen from a regulatory perspective regardless. But again, it's also around risk and opportunities. There is a lot of research, and PRI is listing a lot of it. So again, go and read the material. But around how DI laggards are more exposed to scandals, yeah, negative financial performance, two things that no investor really like, I guess, unless you're a short investor. But something to definitely be mindful of. But it's not only about risk; it's also opportunities, because the companies that are doing DI well, it has been proven over again that they get more innovation, they have happier employees, they attract the right talent, they produce the right products that are fitting to the market, and again, a better brand reputation. So maybe in this small anecdotes from many of the discussions we're having, these risk and opportunities is especially important for any investors looking into the B2C companies. This is where this is even more clear than for B2B, but again, it's clear for all companies. Then it's around, maybe if we look at the far right on DI as a systemic issue, it sort of says itself, and history has proven this again and again, that social inequalities basically lead to a slowdown in economic growth. Again, something investors are not really interested in, and none of us really are, of being sort of all inhabitants of this planet. But I think the beneficiary preferences is also something that is actually a very good point the PRI brings up, and something we also see that is a main driver for many to do more, is that the preferences of sort of the people with the funds that are giving it to asset managers, so again it could also be the asset owners and retail investors, are changing. So just like today, most people that are getting retirement money from a pension fund, they don't want that money to be given to them on the back of companies that produce landmines and years of suffering that causes. So it's very normal for pension funds, for example, to take companies that produce landmines out of their portfolios. And this is what we're seeing happening more and more, not just around retirement funds, but around retail investors, and just in general, have values that are very different. We'll talk more about that, but especially the new generations are looking at this in a very different light. So this is, again, if you want to keep attracting funds and managing them, this is becoming more and more important to long-term and future sort of success.